If you haven't heard yet, the housing market is in a correction, but there is a lot of conflicting and often confusing information out there about what is actually going on. Things are going down month over month, but in most markets, they're up year over year. Some markets continue to grow and see a lot of appreciation, while others are starting to kind of tank. So today we're going to dive into this and examine what is going on exactly in the housing market here in the beginning of November 2022. We're going to dive into some of the recent numbers. We'll look at which markets are doing the best, which ones are likely to fare the worst over the next couple months, so you can make informed and confident investing decisions. What's going on, everyone? My name's Dave Meyer. I'm the VP of Data and Analytics at BiggerPockets. I'm the host of the On the Market podcast, and I'm the author of the recent book, Real Estate by the Numbers, that teaches you to approach real estate analytically. So if you're interested in anything, you can check that out. You can also connect with me if you have any questions about this video or really anything at all on Instagram, where I'm at The Data Deli. Okay, let's jump into the recent numbers, and I'm going to share my screen here, and we're going to look at some recent data that Redfin put out. It is the beginning of November when I'm recording this, but just so you know, we are looking at September numbers still. So a lot of the big housing market data comes 4 to 6 weeks late, and so it's not the most recent data, but it still does tell you a lot about what's going on in the market. If just a tip, if you do want more recent data, Redfin's data center, you can go to redfin.com, I think just /data. They have weekly data there, so you can go check that out. But I like looking at the monthly data because it's less variable and it's super helpful. So what we can see here is that this top line here where it says median sales price really explains a lot of the dynamic of what's going on in the housing market right now. You can see here that month over month, that means from August 22 to September 22, the median sale price in the US went down about 0.5%. So that's not crazy, but it has been going down month over month pretty consistently since June. So it's kind of steadily declining. The thing to note, though, and why that some people are saying the housing market's up and some people are saying the housing market is down, is that year over year, which is comparing September 22 to September 21, housing market is still up 7.5%, 7.6%, which is a lot. And that is why people are disagreeing about this. Generally speaking, though, in normal times, what you care about and how the housing market is normally tracked in normal times and pretty much always is year over year. So that's why when people say the housing market is still up, they are technically correct, and that is typically how it's reported, is that it's year over year. But as I said, that's in normal times. We are not in normal times, and so it is useful to look at this month over month data. But seeing prices go down from August to September is not really that unusual. It's actually common. That's normally what happens because of something called seasonality. Prices go up in the summer, they start to go down in the winter, and we're seeing a normal pattern. The other things I want to call out here is that the number of homes being sold is just absolutely tanking. And this is important for a couple of reasons. As you can see here, homes sold year over year down 25%. Pending sales, which is basically homes that are under contract, are down 25% as well. And this is really significant for two reasons. First and foremost, when home sales decline, prices tend to decline as well. The second thing is that generally speaking in the economy, housing and housing activity contributes something like 15 or 16% of the total GDP in the country. And so when you see a decline in housing and construction and transactions, it does have implications for the broader economy, and we're seeing major declines there. The last thing I want to share here on this screen is that new listings, which is basically the amount of people who are listing their property for sale, it's down 22%, which is huge. This is sort of the seller's revolt I've been talking about for a while, is that now that people have anchored in their head the prices that we were seeing back in June, they don't want to sell their price for the price they can get now in October or November. And so they're going to wait it out. The average US home buyer is in an excellent position right now to service their debt. Foreclosures, defaults are super low still. And so you can see that people, if given the choice, they're just going to wait it out. They're not going to sell for a loss if they don't have to. So these are some of the dynamics that are really important to the market. Things are going down. We're seeing prices go down, home sales volume go down. That puts downward pressure on the market. But sort of a counteracting force is that new listings are up. And I'm not saying that prices are going to go up, but it provides upward pressure. So you have these two different forces going against each other. And who wins, what happens with that, we don't know. But overall, I do believe there's a lot of downward pressure and prices are going to go down. Another thing just to call out, which is crazy before we move on, is that the average 30-year fixed rate mortgage in September was 6.11. Now, a couple weeks later, it's way higher. It's like 7.1 now. But in September, the average was 6.11, and that was up 3.21 basis points or 321 basis points since last year. So it's basically doubled, and that's the reason we're seeing so much pressure on the housing market is because it's not affordable anymore. So that's one way to look at this. So now we can see what happened in September. As of September, there was only a handful of markets that were down year over year. Again, that's the one we really care about. We saw Oakland, we saw New Orleans, and we saw San Jose, California. We're all down during September. Everything else was still showing year over year gains, but the gains are really compressing to the point where we're probably going to see every single month from now for, sort of the indefinite future, we're going to see more and more housing markets probably turn negative on a year over year basis. Now, the question becomes, what happens next? And I want to share some data with you here from realtor.com. And they put out some really good information that you should check out if you're interested. So what Realtor puts out is inventory data. And the reason I like to look at inventory so much is because it's what we call a lead indicator. This is basically one data point that helps you predict future data points. And inventory helps predict prices in the future, because when inventory is low, that means it's a seller's market usually. And that tends to mean, not always, but that tends to mean that prices go up. When inventory is relatively high, that means it's a buyer's market and prices either stay flat or they can go down. So if you look at this data, you can see from Realtor, I filtered this to just the top 250 largest markets, just so they're more recognizable names for people. But if you want to, we'll put a link in the show description if you want to just download this stuff from realtor.com, you can for free. It's really cool. So you can see median listing price, let's go to active inventory. So let's look at inventory month over month. You can see that a lot of them are going up. In Raleigh, North Carolina, it went up 18% in just 1 month. That is crazy. Greenville, North Carolina, 15%. Jackson, 14%. A lot in North Carolina. You also see Durham and Chapel Hill. You see a bunch in Texas here, in Kylene and Tyler, McAllen. And so these are markets, to me, that are probably going to cool off the fastest because we're seeing so much more inventory so quickly. You can back that up with days on market, which is another good measure, another lead indicator. And you can see here in Raleigh, the active listing count went up 18% in a month. The days on market went up almost 40% in a month. So this is a strong indicator that this market is cooling really, really quickly. If you want to see year over year, that's where things get crazy. Look at this. So if I filter this by active listings year over year, you can see in Ogden, Utah, up 180% year over year. Phoenix is 160%. Raleigh, 166. Now, it's important when you're looking at this year over year data to remember that last year inventory was one of the lowest it's ever been. So it was kind of artificially low. So those are kind of crazy, but still, it is very worth noting these huge jumps in active listings. You can also see some other really helpful data when you download this. I actually deleted a couple columns to make this more readable, but there's way more information when you go and download this. So if you want to look at median list price year over year, you can see some of them are still huge. Wichita, Kansas, 40%. Springfield, Illinois, up 64%. So there's still things that are abnormally high. Miami, look at this, 28%. We're seeing, let's pick another big city. Not that these aren't all big cities, but yeah, Greensboro. So a lot of them are up multiple points, actually. So that's interesting. We're seeing big C's are probably smaller. So now if we look at the ones that have gone down, this is listing price, not sales price. We see Salinas, California at negative 14%. And most of these year over year are not negative. So that's what I was saying earlier. Only a few markets have turned negative year over year, but I expect more and more of them to over the next couple of months, because even these ones that are sort of neutral, haven't gone negative yet, they have big upticks in both their active listing and median days on market, which again are lead indicators for what happens in price. Last thing we'll look at quickly here is new listing count. Let's just look at this. We're seeing in Laredo, Texas, new listings went down 24% in just a month. We're seeing Corpus Christi, Texas, 23% down in just a month. And so again, these are places where, although even if active listings, even if days on market are going up, which they are modestly, I mean, in normal months, this would be a lot, but compared to some of the other things that we've seen, they are seeing counteracting forces. Inventory can't rise that much if new listing counts continue to decline. So this is a really good way of just looking at your local market and determining what's happening. You know, are you seeing listings drop? Are you seeing inventory go up? Are you seeing days on market go up? These are the key questions that will help indicate how much your market goes down, if it goes down at all. My guess is that most markets are going to turn negative over the next couple of months, but there's going to be different degrees, right? We're seeing markets like, Reno go down huge, but markets like Boston and Chicago are doing okay and might only go down 1 or 2 or 3% over the next couple of years. So really important to check that out. Along those lines, I'm going to move over to a different screen share here and show you this map. And so this map comes from a company called Moody's Analytics. You may have heard them. We actually had one of their chief economists, Chris DeRitis, on my podcast On the Market recently. And what we're showing here is Moody's forecast. So the data I was just showing you can help you make your own conclusions, your own thesis about what's happening in your market. Moody's, big analytics company, national analytics company, does a lot of this on their own. And they've created this heat map here that I'm showing that shows what they expect for a peak to trough decline. And peak to trough basically means the highest point, which was likely already happened, which was probably June 2022, to trough, which is the lowest point during this market cycle. And we don't know when that's going to be. That could be this winter. It could be next winter. It's usually in the winters, not in the summers. But generally speaking, we just don't know when that's going to happen. But according to Moody's, most markets will decline somewhere between none, just basically staying flat, and 25%. They see the biggest downside risk as 25% drops in the market. And you could see, according to this heat map, that the darkest purple is the places where they see the biggest risk, where it can be somewhere between, let's say, 20 and 25% declines. The big notable areas here are mostly west of the Mississippi. You see Arizona just is sticking out really big here. You can see huge swaths of Arizona are at risk. Idaho, look at the Boise area here. It is the darkest of purple. So you're seeing a lot of Idaho really there. You see modest declines, 10, 15% here. It's not modest. That's a big decline, but compared to some of the other ones, 10, 15% here in Colorado. And then the other big area here we're seeing is in the Portland, Seattle area, Washington, Oregon, up on the top left. You see some areas of Tennessee here, but for the most part, the Midwest, if you look here in Chicago, if you look in the New York, New Jersey, Boston area, New England, not looking as bad. And so this is why when we, as investors, are trying to figure out what to do about your investing, where to invest, how much to offer on a property, it helps to understand what's going on in your market. Because if prices are only going to go down 3 to 5%, if you can get a deal 3 to 5% under asking right now, that's going to protect you from any downside risk. But you wouldn't want to do that in a market where, let's say Reno, right, where it might drop 25% and it's only gone down, 3% right now. You need to get a deal 10, 15% below market value to protect yourself against that downside market risk. So doing this type of analysis, understanding what's happening in your market and understanding what markets are most likely to decline. And again, this is mostly in the West Coast, Arizona, Idaho, Oregon, Washington, some parts of Texas, Tennessee, and Florida, and North Carolina, are all areas where you're going to want to be extra careful. This is a time right now where there is good opportunity in the market because sellers are generally more willing to negotiate with these types of market dynamics, but you have to be really careful and there is more risk with that more opportunity. So hopefully go do this analysis yourself. If you have any questions for me about this video or anything else, hit me up on Instagram where I'm @TheDataDeli. Thank you all so much for watching, and I'll see you next week.